record. Yes, I'm just going to recording just in case if anyone's saying, Frank, can you upload a video? I don't know why anyone wants to see that. And for people who are on Zoom, can you see my iPad screen?
Yes.
All right, good. Because you don't have to see that. That's just my projecting the iPad screen for everyone over here. Should we? How should we run this? Do you guys want to run this as a more like a tutorial type or more like lecture type? Or is there any particular week of content that you struggle with? Or do you want me to give you like a quick overview of the second half? I mean, presumably, geez, that's really bright. Presumably, a final exam covers from week 1 to week 12. Is that right? Yeah. All right, week 1 to week 12. And do you know how many questions that you will have? No, not many. Not many or too many. Do you guys know how many, for example, how many MCQ questions and whether you're going to be given formula sheet? Open book? Yeah. Okay, all right. Open book that makes it so much harder. It's a bit unfortunate if it's open book. I mean, let's say if I were the one that write exam, not for FINA2204 interactive finance, except that one, but for every other unit, if I write it as an open book exam, normally I won't ask you anything, just applying the formulas, because obviously you have the formulas there, right? So there's no point to say what is the formula to get Black-Scholes option price. But here's the but. Given that Andrew only runs this for 1 unit, I just assume that he would be very kind-hearted and just saying, I want you guys, or I want everyone to pass. So I don't know. I mean, I can't. So, but if there's any sort of formulas that you have to memorize, you don't have to memorize now, as long as you know where to go, right? As long as you know where to go. Just quickly check. It's too new. Talk about calculating concept, floating rate bond. Geez. So someone asking about floating rate bond. Does anyone remember what floating rate bond is? No? Yes, no, yes, no. So let us just quickly go to floating rate bond. I mean, it's actually not a bad idea to start from bond. Would you mind tell the type of question? I don't know about that, Zul, sorry. And I may look stupid on the camera, but it's fine. Let me reshare, just sharing my screen, so I can talk about it. See that? This is my teachings. I've done a lot of teachings. I'm just actually going to use my own slide, which is the same as your slide, I presume. That would be week 6, isn't it? Swaps. Click swaps. All right, so actually this we can start from week 6 and then we can move on or move backward, move forward. So swaps is actually one of the most difficult weeks for students. The reason why being is that there are so many angles that you can teach swaps on. Could you guys see my computer screen, the PDF? All right.
Yeah.
All right. Good. Thank you. But what we focus on in this unit is just focusing on the periodic, sort of like using the one of dealing with interest rate swap and currency swap. So we only need to worry about 2 swaps, and actually to simplify it, we're only going down to just using one way to evaluate them. There are many other ways to evaluate them, and because it's not like a physics science that there's one law governing all the pricing. But over here, there are many different approaches. So let me just quickly go over the slide. It may not look exactly like your version, because I don't know whether Andrew will make any changes, but it will be roughly the same, right? I doubt that there'll be many differences. So the first thing you want to know about interest rate swap is that, I mean, why do we have a swap? Why do we even create swaps? What's the purpose of having swaps? Right, for those of you, about like 3, 4 of you in my tutorial, 5 from my tutorial, you probably should be able to answer that question, right? What's the purpose of creating a swap? Well, the reason why we create a swap is because even though it looks like a futures contract, I mean, people say a swap is like a multiple forward contract, right? So let's just say if you think about it, like let's say if you have 4 payments in a swap, you can think of it as like 4 forward contract, right? Because like we predetermine and then we finalize, we deliver, we exchange cash flows at that point. But then people go, why do we even have swap? Why wouldn't you just write 4 forward contract, right? But the reasoning behind that is that, well, there are certain natures with our product that we have periodic cash flows. So so let's just say, why don't we have a gold swap, right? I mean, if you go back to the start, if you look at all the examples, why do we only look at interest rate swap and currency swap? Well, that's because we don't care about anything else. Like gold swap, why don't we have a gold swap? Why don't we have a BHP share swap? It's because the nature of this contract is only just once. So let's say if you buy gold, likely you buy it just for once. You're not gonna buy it multiple times. You're not gonna buy every 3 months, unless you're like a jeweler that you buy gold on a periodic basis, like every 6 months. You buy the inventory. But otherwise, it's very conventional to imagine that gold delivery and gold transactions only just once. But interest rate contract. Think about mortgage. Think about if you're paying back your Huawei, paying back your whatever, like your credit card, right? You have to do a monthly repayment, right? So which means that there will be a nature of periodic payments involved. So which means the reason why we design a swap is because we have such needs. We have this need to swap the cash flow on a periodic basis, as well as currency swap. But currency swap here is very much just like interest rate swap, except it's swap with different currencies. So which means we're still dealing with interest rate payment, but except that now we're dealing with multiple currencies. All right. So and make sure you know how to, I mean, what this means. And so here we don't actually use this, but we talk about it. Maybe Andy talk about it. Maybe not. That is the FRA basis. All right. So now let's talk about pricing an interest rate swap. So to price an interest rate swap, you need to know that we have 2 parties involved, right? The first party is the one that agreed to pay fixed rate, and the other party means that he will receive fixed rate and will pay back the floating rate. So the floating rate means, what does floating rate mean? What does floating? I mean, floating is a very finance word. You don't use that floating for this meaning. Only in finance context. What does floating means? What floating means? Floating, yes, you see the water level, right? Floating. Adjusting to the market rate. Yeah, adjusting to the market rate means, well, it means it's kind of like there will be changes to it, right? So it's not going to be fixed. That's sort of in contrast to what a fixed means. Floating just means that it depends on the level of the rate here. If you want to go check the water level over there, the time may be different. So we call it floating rate. So, but there's one very important foundation in thinking about creating a swap. There are 2 things. Actually, let me now start writing now. New share, iPad. Let me try to see here. Swaps. Oh, of course. And this one doesn't work. Okay. Loading. Loads, swaps. All right. So swaps. What we have here is that there are very important conditions. The initial value of the swap equals to 0, right? Just like forward contract, just like futures. The initial value all 0. That's something that is just make it so special. The reason why it's 0 is because it's designed to reflect the nature that neither of the party has more knowledge than the other party. Because if I see it, I will block the camera. Don't worry. I mean, they see the majority of my head anyway. Actually, because they don't have to see me, right? Yeah. They don't care who I am. It's fine. All right. So yeah. And secondly, we determine the floating rate payment you can think about it's like in advance, but I think we use in arrears in the actual lecture note. But what do you mean in advance is that at time 0, say here are all the payments. At time 0, we determine what a floating rate payment is at time 1. And this is actually not an assumption. This is just reality. The reason why we do that is because, let's say if you go to the bank today, right? The bank will tell you if you put money in here, let's say for 6 months. Let's say here is swap payment every 6 months. If you go to the bank, they will say, well, I can tell you if you put your money here in the bank for 6 months, I will give you 2.5%, right, per annum. But you can change the conversion. But if you ask them to say, if I come back on June the 15th, what will be the 6 months rate then? They will say, I can't actually tell you accurately. But my suggestion here is that it may come back later, right? But it will be roughly the same. But again, nothing's guaranteed. We don't know because no one knows for sure what the future is going to turn out to be, right? So which means that here is not an unreasonable assumption to say we're going to determine the floating rate payment right at the start. So which means here we observe what the floating rate is for this period, and then we determine what my floating rate payment is. And when do we exchange our payments? Time 0 or time 1? Time 1, that's right. Time 1, interest rate. Remember, there's no exchange of cash flows at time 0. So we swap cash flow at time 1. So what we have here is that we're gonna have FL, F fixed. So so that could be plus, that could be minus, depending on which one you pay. So here we receive floating, we pay out fixed, and then right at that point. Now I'm in time period 1. Imagine we are in time period 1, and now I can see what the next 6 months interest rate is going to be, right? Again, this is not an unreasonable assumption at all, because at that time, I can go to the bank to say, what is the interest rate? And the bank will tell you, well, today come back is actually 2.25% rather than 2.5%. So, well, the interest has come down, but that's fine. You take it because that's what you will observe, right? So I just use a different color, floating rate 1, and that will cover this period such that that rate will be charged over here, right? And so if you understand the nature of this design contract, presumably if you've done your assignment, yeah, you know the nature of that, right? And that just means that when you're pricing it, it's actually a lot more straightforward than the other one. So for the fixed rate payment, so here let's talk about floating rate payment. Is that we do it backward. Let's say here we have 5 periods. I don't know, let's just guess. So let's say here we have 5 periods. What we're assuming we have here is that, well, at this time, we will get a floating rate payment that we have done in payment 4, plus the whatever actually let me check what the notation I used. L, yeah, L. I don't know why people are using L for principal, but that's the term I have. So what is FL4? FL4 here is the floating rate times L. Yeah. All right. Let me just be consistent with my own notation. And where do we get FL4? FL4 was obtained at time period 4, right? So here we observe that at time 4, we observe what? Sorry? Floating rate, yeah, FL4. Sorry, excuse my writing. RFL4, right? So at time 4, we observe that. So we determine that's going to be our final payment, right? And then so over here, if at time 4 you observe that, which means if you want to discount, so the present value of my RFL4 times L plus L at time 4 what would the present value be? So from the present value that you learned from Introduction to Finance is that I'm going to be discounting it using whatever the market interest rate is, right? So which means at time 4, that is simply just RFL4 times L plus L divided by 1 plus RFL4, right? Because we observe that interest rate. So which means it's fair to using that interest rate, RFL4 here, to discount out my value back. And then if you're sort of good at math, you just know that that's just L. So which means the present value of your floating rate bond at time 4 is back to L again. So now you're back to L. We need to incorporate that at time 4. We have a payment, a floating rate payment, which is RFL3 times L. And how do we get RFL3? RFL3 is what we observe at time 3, right? Because that is the nature, right? We determine that in advance, right? So RFL3 was determined here so that the present value of RFL3 times L plus L at time 3, again, is just going to be RFL3 times L plus L divided by RFL3, right? Because that is the market interest rate that we observe at that point. That's the market interest rate we observe at that point, and we use that to discount, right? So that again is L. So if you do that over and over, you will just arrive at the point where the present value of that is just what we have on the slide. Let me share the slides now. Fix is very easy. It's just L. So that shows you why a floating rate bond at time 0, the value of that is L. But of course, what happens if it's not at time 0, right? If it's not at time 0, then that means, let's just say here, let's say we care about here. Let's say we are right here, and my next payment is going to be RFL0. Yeah, oops, I have to share there. Don't worry, we'll get used to this. Technology. So if you look at it saying what is the value at that point? I know at time 0 is just L, but at that point, what's my next payment? My next payment is going to be RFL0 times L plus L, right? And so which means that I am this time period away of getting that. So which means the value of that at that point, the value at that point is going to be the present value of this, right? And then the rest, you just stick with the notation, whatever you use. But that's the concept, right? The concept here is that I am that much time to getting my next payment. And do I need to care about all my remaining payments? That's one question people usually ask. Do I care about all this time point here? Do I care about my floating rate payment over here? No, because it's all summarized into this L. That's all consumed within that L, and that represents all your future payments, as we just saw. Right. Let me quickly check. Is that all I want to say? Yeah, that's all I want to say. Check them. Andrew mentioned about bootstrap calculation. Is that important to understand to use it? Laura, I guess my my answer to that is I don't know. I don't use bootstrap calculation to calculate bond price, and I don't know why you would use that to calculate swaps. I don't know. If it's not covered in your learning objectives, I would say probably don't worry about it, right? Because after all, everyone has to stick with the learning objectives, right? Hopefully that answers the question. All right. So and so while we're here, and let's just quickly go through the rest of the swaps over here. So choosing discount rate, and in US and people use LIBOR. In Australia, we use bank bill swap rate, SBBSW, and
not sure about what Andrew talked about. We had an update on how we actually arrive at bank bill swap rate. Previously, it was just determined by a number of banks. In the morning, they have an auction and people auction what the interest rate is going to be. But then it turned out to be a manipulation. And then we changed how we calculate bank bill swap rate. But in your case, it's going to be given that, right? So I strongly encourage you to check your understanding on any of that. You make sure that you know how to calculate them. Like, for example, let's say if you're given a table like this, you should be able to know how to do it. You should be able to calculate value of swap. And as we saw that before, the only difficult part is that it's intuitively understanding how you calculate the bond for floating rate. And once you do that, the fixed rate is just like what you learned from FINA2204, right? What the future payment is, fixed coupon payment, discounted back to the future, you work out the value of swap. And currency swap here, as you can see, currency swap here is similar to interest rate swap, except that we're just going to be denominate one of that in a different currency, right? So there are many different types, but we stick with one of the easiest ones, fixed, floating. We just stick with fixed and fixed, right? So everything is fixed. But you could imagine if you are doing floating fixed, how you would deal with it, because floating one, as we just saw from the interest rate product, just L plus RFL times L, right? It's just that. I mean, doesn't matter which country it is. The same thing goes. At this time, at time zero, I only observe the interest rate for next 6 months. It's the same concept, right? It's just gonna use in different way. But I guess just, we're trying to simplify it. As long as you understand it, you should be able to work that out. So knowing how to do this is important. Knowing that the difference to an interest rate swap here, we have an exchange of principals. So that means that at time zero, there's an extra cash exchange. So like interest rate is just nothing happens until time one, but here something happened at time zero, right? And understand how you should do this. Then valuing a currency swap is just this, right? So again, knowing how to deal with the exchange rate, and is important. It's important to know how to convert your interest rate back to exchange rate back to whatever the currency that you want to work in, right? All right. Let me think whether there's anything else that we can talk about in this way. Let's go to the tutorials, because yeah, so I actually explained all that in my tutorial slide. So if you're not sure, you can go to my personal website, and the personal website is here, frankliu.info, FINA2204. I have all my tutorial slides loaded over there. Some of the weeks with additional handwritings, just in case if people don't understand. And in that week, I think I talk about how to price in that, because someone asked that question, say, why is the floating rate L? So I just explained it just again. And it's, it's important for you to know how to do all that. I think there's one question I remember was being very interesting is, oh yeah, it's that one. Is that problem. I think problem 720 and 719 is to work out which rates that you need to use, right? So here, I mean, apart from valuation, apart from knowing the cash flows, problem 7.19 and 7.20, if you are not completely, your understanding is not completely thorough, I would encourage to go back and check again. So I think this question is saying, here I am provided with a quote from the market maker. So the market maker, I mean, the reason why we have a very active swap market is because banks in charge of that, right? And how does bank get profit? The bank get profit from, again, information asymmetry, is that because they have a lot of clients. They know who's actually borrowing, who's actually lending to them, right? And they're saying, and they can always figure out a way to encourage more transaction. If you can encourage more transaction, you can walk away with transaction fees as well as here the midpoint of the bid ask. So in this case, we were talking about here a company A has been offered a rate showing this table is it can borrow. So remember here we're trying to borrow. You can borrow for 3 years at 6.45%, and that means now if they can borrow at 6.45 but they decide not to, how would you work out what the floating rate is that is applicable to this company A, right? So and if I guess it always is a lot easier for you to draw a diagram. So that means that in this case, if first of all is borrowing. So which means if it's borrowing, that means here we have a rate that is paying out. So this is what's given, which means that I'm currently borrowing, that I'm paying out, but I don't want it. So if I don't want it, that means I want bank bill swap rate, right? And that means I'm paying out bank bill swap rate to market maker, and the market maker will come back to say, well, you pay me this, I pay you this instead, right? I pay you this instead. So that means in this case, is the market maker is paying them. And if you think about intuitively, would the market maker want to pay them more or pay them less? Market maker is the seller. If the market maker is saying, I'm going to pay you something, would the market maker prefer to paying more or paying less? Paying less, exactly. So you can understand about from a bid ask point of view, that's fine. You can also understand it intuitively, right? Means here the bank is paying you, right? So draw this box and draw that and draw the arrow, but cover this. So let's say here, I mean that is really the main part of people say I don't understand. It's just the main part. I say what number do I use, right? Draw everything else so that you know A is paying out, A is paying market maker's bank bill swap rate, and the market maker need to pay back something. They can't walk away with nothing, right? So which means in this case, what is market maker paying them? Well, go back to the table saying, well, if the market maker is paying them, they will prefer to pay a low rate, right? So which means in this case, looking at year 3, because 3 years, right? 3 years. Year 3, the one is lower is 6.21, and that's how you determine. Well, that's the number to be used, 6.21, right? So 6.21%. And yeah, so which means in effectively, A is paying bank bill swap rate, receive 6.21, pay out 6.45. So in net, they pay out 0.24. And that's how you determine A here is paying bank bill swap rate plus 24 basis point, 0.24%, right? So and the same argument can go for the other 4 examples. And I guess this is probably the one that is most applicable to our daily life, right? No one's going to ask you to evaluate swap, but there will be chances here people could get you to say, what number do I pick? So make sure you know how to tell them what number you'll be picking, because if you're telling them 6.24, that would be quite embarrassing, right? And then here, and then 7.20 is where the other cases is that I am investing. So which means I will receive a cash flow. So if I receive a cash flow and I don't want it, and I'll give it to the bank, and that means here again, the bank will give me back bank bill swap rate, right? Because let's say if I receive fixed rate, give back to the bank, and the bank here, well, the bank can only give me bank bill swap rate. So which means in this case, that means I am I am buying something from them, right? I'm buying bank the bank bill swap rate. So in this case, if I'm buying from them, then I will be charging a higher price, which is 6.39%. So I'll have to pay 6.39% exchange for the bank bill swap rate. And then again, you should be able to calculate the net changes and bank bill swap rate minus whatever that is, right? So I wouldn't say exactly straightforward, but if you take time just to figure out why that's the case, make sure that you know, as a starting point, you should know how to do tutorial questions, right? And you should be very familiar with all the tutorial questions. And all right, so that is week 6. That's week 6. So I'm looking at a question. No one is asking a question. Do you want me to keep going from week 6 onwards or going backward? 7, 8, 9, 10, 11, 12, 7. All right, cool. Because I think I have a slightly different version of the lecture note to Andrew. Let's go to week 7. So, and let me quickly. What's that? All right, that's the same version. So week 7 is, I would say, week 7 is the foundation for the remaining unit, which means that I don't think there's anything specific about week 7 that is unique, right? Because week 7 come back again in week 8, come back again in week 9, 10, 11, and 12. So week 7 we talk about introducing options, and then so knowing that what option is, what call option is, put option is, and who is the buyer, who is the seller, and often the buyer and the seller is different from the buyer of the underlying asset and seller of the underlying asset. So make sure you know that. So let's say if I ask you Lavender, right? What does a short put option do? Short put. Short put. What does a long put do? Ju, Li Ju? Yes. Long put. Long put. And what do you do in long put?
So buy
Buy the option, and then what do you do with the underlying asset?
buy the stock.
Well, long put is that I'm buying the option to sell the underlying asset, right? Make sure you know that put options are associated with selling. So which means long put means I'm selling the asset. Short put means that I'm obligated to buy the underlying asset. But short put is the one that's most confusing. So short put is the one that I sell the option to buy something. So that which is why if you can always get people to say, what is short put? Long call is the easiest, right? Long call is I buy something to buy something. Short call means I sell something to buy something. Sell something to something else. Sorry, I sell something to sell something. Where for long put, I buy something to sell something, and short put is I sell something to buy something. That's the most confusing one, right? Tongue twisting as well. So, and then knowing that the difference between American and European, but again, that's pointless because the rest of the week all talk about all this European, American, option, price, expiration day. So yeah, draw the payoff and profit diagram. And I don't actually know how you would draw a diagram on LMS. So I don't know how you're gonna be asked questions like this. So do you guys know the format of your exam? I'm just curious because I know as little as you do. No? Is that sorry?
No information is released.
And is that, but it's gonna be based on LMS, right? Is that is that camera on or camera off? Off. I'm free on that day. I'm kidding. I'm kidding. I'm kidding. I'm kidding. All right, this is recorded. I'm joking. And yeah, that's. I don't actually know how you say, because usually if it's a paper-based exam, I will get you to definitely to draw the payoff diagram and profit diagram of the option strategies. Right. In this case, without that, I don't actually know how to do that. So maybe there will be multiple choice for you to say which one it is, I guess, but it's important for you to know how to do it, right? So over here, if you take a look, you should identify which one is the payoff, the red one, and the black one is the profit, because profit here incorporates that there is an initial cost. And this is where people get confused, right? This line here, this is not a time series map. This is not a time series diagram, such that here, although that is time 0, and you pay that amount at time 0, but it's really just a coincidental that, that is when stock price at the maturity falls down to 0 and you have to pay that. But this is not time series, which means this is just one at one point in time at time t, right? One point in time at t, and we ignore the time value of money. So technically speaking, that should be the future value of C0, which means minus C0 times ERT. It should be that, right? But here we just for illustration purpose, we remove that. So finance people are very contradictory to themselves. So even though we care about time value of money, but for drawing we say, oh, that's roughly that, right? Roughly that. Yeah. So I would say week 7 is probably the easiest one, because you need to know that for the rest of this unit, right? There's nothing really specific about this. I guess the only thing that you may get to be asked, from my point of view, is knowing the effect coming from dividends and stock splits. So I think we have tutorial questions for that. I can use that as an example. MCQ. So Laura saying MCQ, but I guess it's a guessing, right? So I don't know. I mean, if I were the one who write exam, I prefer writing MCQ. Then I don't have to hire people to mark the exam paper. I just use the machine. I know it sounds bizarre, but that's the hard reality, right? And then once you start hiring people to mark the exam, there could be disparity against different markers. Because some markers think, oh, you should get 4 out of 5. Some markers think you should get 3 out of 5, even though we have a very strict marking guideline. So 9.20 is the one that I guess is the only thing that week that does not come up again in other weeks, is knowing how the stock split, cash dividends, stock dividends will play an effect in your strike price and in the number of shares you're trading, right? So again, you guys all have seen the answer now, but let me just quickly talk about it. So in this case, the one principle for you to walk away knowing with is that your whole settlement transaction volume, your dollar volume, should stay fixed. So which means if you think about it, we have 500 shares because you are going to buy 500 shares, and you have a strike price of $40. So which means your dollar volume is going to be 40 times 500. So which means your whole transaction value should not be impacted by whatever is doing over here, right? We're not value creation, nor value destroy. So which means that just stick with that in mind. So which means that is 20,000, and that means everything that is done over here has to have a final value to be 20,000. So stock dividend just means that if I am an existing shareholder, I will get paid a 10% stock dividends, right? In a different unit, I may ask you saying, why do the firm do that, right? Why would the firm pay you stock dividends? But in this unit, you don't have to worry about why. You just need to know how. I mean, like what's kind of impact to your strike price. So in this case, because you get paid extra stocks, that means there are going to be a lot more shares outstanding, which means the strike price has to be adjusting downwards, right? Adjusting downwards, and the number of shares will adjusting upwards. But exactly how much is that? Just remember that the product has to be the same again. So which means that I am 10% more. That means I will be buying 10% more shares at a 10% less price, such that 550 times 36.36 still yield at 20,000, right? It's the same product. And the same thing goes with C, where if you're getting a split, if you're getting a 4-for-1 stock split, Apple does that a lot. I don't know why Apple does that, but because Apple share prices keep going and people think about that emotionally, I don't want to buy something that's $200. I think that's expensive, right? So Apple say, all right, fine, I'll split it to 20, right? So which means now it's going down to $100 again. And then people say, oh, suddenly it's a lot more affordable.
but it's the same thing. So here, 4-for-1 short split means that I'm just gonna price going down, shares going up by how much? Well, 4 times more, about 25% less, 25% of the original one, and that's how you get it, right? Such that the product is still 20,000, right? It shouldn't change your dollar volume of the transaction. And for cash dividends, this is the one that is sort of like, that is what is a lot more common. And so those two, the other one, they are not as common as that one, cash dividends. So cash dividend just means that I'm gonna pay you cash to whoever is holding it, right? Let's say if you are a long put position, do you get paid dividends? No? No? Come on. No? Yes? Yes? No? But what do you do in long put? Yeah, well, then you get a claim to the dividends, right? And for long call, you don't. So just remember, you know that, because that's important for the next week of the relationship between dividends and the price premium. So which means that in this case, we assume that when you write the option, that company usually pre-announce the dividend plan. It's not like they will give you a lot of surprises, but they do. Well, I'm not saying they don't, they do. They do give you surprises by canceling, but they don't give you surprises and say, haha, I'm gonna get paid with dividend next month. No one do that, right? So, but they will say, unfortunately, due to other event and due to we want to grow the business, that we don't want to pay dividends. They will cancel it. So, but they don't actually just give, they're very unlikely to say, next month we're gonna pay you dividends. They would announce that in advance because people like dividends, right? A lot of investors like dividends. But they hate the point, they hate the idea of you announce to give me and you have to cancel it. But unfortunately, that's what a lot more common, they will cancel it. So which means that usually when you write the option, this information is already incorporated, which is why in your week 8, 9, 10, 11, 12, we have a different formula for cash paying dividends, for option paying dividends, because this is a lot more common. People actually know that, and we assume you know that information. So that if you know that it's going to be 10% cash dividends, nothing's going to be done to strike prices. Nothing's going to be done to the number of shares that is linked to the option contract, right? But the other two is different, right? Because the other two change the nature of your share base. All right. So and given I've actually got a question from the chat box, and they're saying, let me check again. I forgot which question that was. 3.22. So I guess it's probably interesting to go back together to look at what 3.22 is, and then we can come back to week 8. Do we even have 3.22? All right, so Nicole online and is asking this question about 3.22, and we can look at together as well. And it's been a while for me to read that question, so we can take a look at together. It is 1st of November. Someone needs to purchase in 20,000 kilograms of Gracie wool on 18th of November, and the December futures price for Gracie wool is currently 215 cents per kilogram. Contract size. Designing a hedging strategy for this manufacturer using the December futures contracts. Using the concept of basis risk, determine the outcome of the hedging strategy if the spot price on 18th of November is 200 cents. Yeah, that one is wrong, right? 200 cents dollar. I don't know what I mean, but I guess it's 200 cents in Australian dollars per kilogram, and the futures price is that. So week 3 is week 3 is on hedging with futures, right? Hedging with futures. So throughout the years, that's turned out to be a difficult one as well. And the reason why it's difficult is because, again, people don't understand the intuition of why we hedge using futures. Why do we have that week? And last time I came here in March, we talked about it. The reason why we have this week is because we could have done it perfectly with forward contract. But we don't go with forward contract because forward contract is risky and is illiquid.
and we want to use something standardized. We want using futures contract as such that futures contract are standardized, which means that it does not meet your needs in particular. And that's why we have to deal with all the basis risk, which means that it's going to be an imperfect hedge, how you handle it, right? And so in this case, because this manufacturer needs to purchase, you can think of it is that, well, if you need to buy something, that means currently you shorten the position. Or I mean, I don't want to use that analogy, but that's what people think in finance is that if you want to buy something in the future, you can think of it as that currently I'm shorting the position such that I will have to buy it later on, right? Although you may not need to buy it, not to buy a cover your short position, but that's what we're seeing. That is that if I'm gonna sell something in the future, that means currently I'm loaning the asset, which means vice versa. If I have to buy something in the future, I'm currently shorting the asset. But you know that's what we think in finance, right? If you don't want to stick with that philosophy, that's fine. You can just think about, oh, all right, I'm gonna buy something. If I'm buying something, how do I hedge? Buy a futures contract, because buying a futures contract help you lock a price, right? Help you lock into a price. So the answer would start with saying, oh, you have to take a long position and you close out the contract because you can't hold it until December, right? So on that day, we need to figure out your basis risk is defined to be F2 minus F2, right? So which means that in this case, if the spot price is 200 and the underlying sort of futures contract price is going to 25, that means your basis risk is minus $5 per kilogram. And that means in this case, how much do I pay? And this is what is important. The net price after hedging. In this case, think about it, right? Because I am buying something. So that means I will be paying. This is how much the contract I have, saying 250, that's what is allowed. Plus the basis risk will give me 210, right? So this is what I originally agreed to. But this is just means that, well, if I sell off my position and buy the underlying, I get 210. This is one way to explain it. Alternatively, and this is my personal preference, I don't like that the other one, right? My personal preference is to think about, if you know basis risk, you can use that formula, which is F1 plus B2. You can stick with that formula, that's fine. But I never like that. It's because, I mean, again, I don't understand why people define a basis risk in the first place. It's just think about intuitively, right? That is because I have to close my position. That means I have to buy from the underlying market, right? I can't actually buy from the futures market, right? Because it's not delivered. So which means you think about it, if I'm going to buy something, I will pay S2 from the underlying market. And just simply think about, I am taking a gamble on the futures position. And how do I work out my payoff? I start with F1, long F1, and that means at time 2, if to close it, you short it, right? Because I have to close it off. So initially I long and I short. So which means F2 minus F1. Because this is what I short, I will receive. This is how much I will pay, F1. So F2 minus F1. And this one is my benefit from holding the futures position. So which means if this number is positive, just imagine, if this number is positive, I'm paying, say I'm paying $100 to buy an asset. But here, I gain $10. If I gain $10, does that mean my overall, do I pay more or pay less? I pay less, right? Which is why here is minus. So in this case, think about this. This is my profit and loss from the underlying. But because I'm buying something, so which means this is the price I pay from the underlying asset. S2 is the price I pay from the underlying asset. And then this is the benefit I receive from holding my futures position. And if that is positive, that means I'm paying less, which is minus. If I have a loss, that means I'm paying more.
and which that explains to you why here is minus, right? It's minus. And for the other cases, if you are short position, that'll be the other way around. But the overall is the same thing. But if you are shorting something, remember here, this is the price you receive. So your argument in your head is like, well, okay, that number has to be plus then. That will be F2 plus F1 minus F2, right? Again, that looks different. So, and that means here, overall, you're paying $210 per kilogram, and coming from 20,000 contract, right? All right. Good. So that's 3.22, and now let's move on to week 8. Actually, let me check what Andrew has for week 8, because I think he may not have used my slides from those weeks onward, because I have different slides. Let me just confirm. No, this one is still fine. So week 8, properties of stock options. So, so week 8, you can think that week 8 is the one that is one of the most important weeks that teach you how to do POCO parity. Like, there are a lot of no arbitrage arguments made in that week. So this one, in my personal opinion, if I would write exam, I will give a start here to think that this is where people can ask a lot of questions about POCO parity, about no arbitrage, right? About the fundamentals of what we learn in finance, in pricing, no arbitrage. So I can give you some examples. Let's just go through the lecture slide very quickly. And learning objective, yeah, learning objectives. So here we have 6 factors: current stock price, exercise strike price, time to expiration, volatility, risk-free interest rate, and dividends. And here is cash dividends, not stock dividends, right? Stock dividends, we do what we did in week 7. Cash dividends is the one that we don't actually make an adjustment, right? But something that we have to be priced in our pricing premium. So here, so this is the matrix that is important for you to know. And again, because of the format of the question is likely to be MCQ, I don't actually know how to ask you a question to say, explain the volatility impact on the premium for European coal and European put, right? Because it's going to be MCQ. So I don't know. But again, if you just prepare it as a normal exam, so I would be knowing, I will be sort of asking myself, how do I derive such a relationship, right? So for example, this should be easy. Why there's a negative relationship between strike price and European coal option, right? Why? Well, it's because here your payoff is ST minus K or 0, right? So which means the larger the K, the smaller the payoff, holding everything else constant. Because all this is derived holding everything else constant, right? And so time to expiration here, the reason why you put a question mark, it does not mean there isn't a relationship. There is a slight relationship of plus and plus if it's just marginally longer. But given there is no limit when you talk about mass or a time to expiration, what if that is like 1 billion years? What if you never exercise your call option? What if you can never exercise your call option? Then that's pointless, right? So that means the value may go down to 0. You can hold it, but it's like we're so far away from now on being expired. So that's why it's a question mark. You can see that it's like this. Up to a certain point, it just decreases. But there's a positive effect for American coal and American put because they can be exercised anytime. Yeah. So make sure that you know how to do all that. And dividends is the one that who was asking dividends. That's what I asked you about dividends, right? So and that relationship is important because you are entitled to get the dividends if you put option. Because the reason why behind that is because usually you are holding a long position in the stock, and the stock then the exchange would actually require you to do that, right? Because they don't want you to be naked, right? They don't want you to be doing something that you don't actually have a stock to sell. But that's the general relationship.
minus plus, and plus minus, and yeah, that one is also a tricky one. About why that's plus, why that's minus, right? You can just think about it. The reason why it's plus is because European core, you are paying something to buy something. So the higher the interest rate, you can get more interest from not paying it until later, such that it's better for you, right? So because you don't have to pay it straight away, and the higher the interest rate, the more interest you can generate from your bank account, right? So that's actually a plus. But minus for European put is because you are selling something. You haven't got the money yet. So which means the higher the interest rate, the higher the opportunity cost for you, right? You may as well rather sell it now, right? So that's why the case, right? And volatility is plus because that just increases the chance of hitting either way. But again, that's increase the premium. And all that is derived in the sort of like model free approach. There's no model behind how you should value call or put. And so here we have a few boundaries, and yeah, I've given this open book that you have the boundary there, but it's important for you to know the boundary. You should know that why, for example, why such and such is the one for call and put, right? And why they have a lower bound like that. But let's just go to over here. Yeah, well, American put. Yes, the POCO parity. So the POCO parity here is that I would say this is one of the most important formula, right? One of the most important formula in real life, because people actually use that. People actually use that, using a version of that to arbitrage away the price difference for the index options, which is why the S&P 500 index options are so heavily traded. It's because there are European options, and if you just look at it, let's say sometimes you may just look at it, well, there's a price difference. So because that one does not require you to have any models for stock price, you don't have to assume any models. This is a model-free result. So I would imagine if a normal exam would ask you to say how you should derive this relationship, and if that doesn't hold, if one side is bigger than the other side, how would you arbitrage it, right? How would you arbitrage it away? And I think that's talked about a lot in that week's. But what should I talk about here? Is that let me think. Do you guys have any question on this slide? No? Yes? Yes? No? All right, good. So, I mean, I will leave that to another time, but I will say this is actually quite challenging, right? Someone actually asked me to prove that, and I proved it on the discussion forum. Some of you may saw it. Someone actually asked that, why is that the case? Is that a typo? Why is that missing a D here? If you take a close look, this is American option dividend paying stock. Why is that one does not look like that? Does not look like here. If you compare that, that's minus D. But there's no minus D here, right? If you take a look closely, and the reason why I decided not to talk about it here is because I guess you may just get confused. So I prefer just to write it down, put it on the discussion forum. Because that person already asked that. How do you prove the other side? Because he asked me, the first question is how do you prove this, right? And I show you how to do that on the forum. And so yeah, just take a look. It's actually not easy, right? It's a lot harder than the European one. Think about how do you come to this the POCO inequalities for American options. I mean, give you a hint. If I were the lecturer, I would definitely ask you that, right? But it is quite difficult. It is quite difficult. Yeah, so some of that have to think outside the box. Yes, so early exercise. So personally, you know, I don't like that. I don't like that proof at all. So if you see my tutorial, you know that I've shown you another way to prove that. So let me actually go to that. Tutorials. No, this is not 1-to-1. It's no, it's 2-to-04. Yeah. So I think generally speaking, you do need to understand why American call is the same as European call, because we're saying when there's no dividend, and it's very common for stock don't pay dividends. It's very common, and in fact, it's common in US, common in Australia, that a lot of stocks that just don't pay dividends. In this case, if they don't pay dividends, American call is the same as European call, right? And the proof is actually very, very elegant. So this is what I did in my tutorial. So if you think about it, that if it's not dividend, American call is the same as European call, and that just means if it is not dividend, it is never optimal for you to only exercise the American call option, right? It's kind of like I just changed the angle of the question, because if it's never optimal to early exercise, then European is the same as American, right? So in this case, we just want to show you, this shows you how finance people think, right? Show you, all right, that means if it's never optimal to early exercise, what happens if you do early exercise? If you early exercise it, the payoff you're gonna get is ST minus K, right? Because it could be 0, it could be negative, but we assume that's a positive right now, right? But what I'm saying here is that if you early exercise it, you get ST minus K. That's why you want to exercise it, right? And that means here at T between 0 to T, at any time between 0 to maturity. And now ST minus K here is less than ST minus KE minus RT minus T. The reason why we do that is because we know that K is bigger than KE minus RT minus T, because this is the present value. Because K times something smaller than 1, right? K is greater than K times something smaller than 1, which means minus K is less than that, which means ST minus K is less than that. So ST minus K minus RT is less than maximum of that, same thing, or 0. Well, that is again mathematically true, because this one is not guaranteed to be positive, but this condition here is guaranteed that to be positive. And this one, as we just saw in week 8, this is the low boundary for call option. So which means this proof shows you early exercising it will not give you a bigger payoff than selling your option. And that just shows you should never early exercise it. Because if you want to liquidate it, you just sell the option, because the option has a higher value than the payoff, such that because it's never optimal for you to do that, there's never a point of that one being than that. Then that means it's never optimal to exercise, such that American call is the same as European call, right? This is one of the sort of like I personally think that is one of the most interesting proof in the options context, right? Does that kind of summarize what finance people think in your head? It's like how would you prove them? Yeah, so go back to that's the lower bound. So you know the lower boundary, right? That's American call, and here is T refers to maturity, but at any time that's just bigger than ST minus KE minus RT minus T, right? At any time. That's a low one. All right, so anything else? I mean, all these graphs just trying to show you that you can't say the same if there was dividend. There may be a chance that you can early exercise the European American call option early for if there's dividend, and we don't know for sure for American pool. Like we don't actually know, right? Maybe we don't know. but if it's maybe, then we won't say it. All right. Let's keep going to next week. Teachings. Week 9. Let's see what does anyone remember what week 9 is about? Oh, trading strategies. Okay. Trading strategies. Trading strategies, yeah, is a difficult one. Difficult because I can ask many difficult questions, but with the constraint of the format of exam, I don't know how I can ask that, or whoever's going to ask you that, right? Yeah, because I've been thinking that question. If I were to write exam, I'll be having a tough life because there's so many questions I can ask, but I don't know how. I guess given that it's an open book, I will be surprised if they ask you saying what does a bull spread look like, because you can just go to a lecture note. So yeah, I don't know how, but I guess maybe those putting a numbers, give you a few numbers for you to play with. So this could be a very easy exam, could be a very difficult one. I don't know. I wish I can bring in more optimist news. Any question with this week in general? I mean, let me start with this. Any question regarding this week? No? Easy? Even calendar spread is easy? Not easy. Let me see what I've got in my. So even though this week, exam-wise, I don't know how difficult that would be, but this is one of the most exciting one in practice, because people actually do that, right? People actually do it, and if you search the name Nassim Taleb, the guy who wrote the Black Swan book, the reason why he can retire early and start commenting other people's, that's because he did it many years ago and he retired, right? Basically, he has the amount of wealth that allow him just to talk about stuff and write books. And so people actually do that. And the reason why people do that a lot is because we never learn from history. So when we price something, right, and doesn't matter which financial engineer you talk to, and it doesn't matter how complicated the model is, we almost always underestimate the likelihood of the tail event. That's just the nature of what we have, So, and how can I give you an example? Is that how many people actually buy travel insurance when you travel? Let's say today, this morning, you woke up, you say, I want to go to Beijing. You're gonna buy a travel insurance first?
Yeah.
Well, then we have one person who buy travel insurance. Good. Do you get a discount from buying a lot of travel insurance?
Not really.
Not really.
Because I don't buy a lot.
You don't buy a lot.
The transportation, what's that? The transportation.
Yeah.
Like the airplane.
Oh, there's airplane.
Yeah. Also some like evidence insurance.
Okay. Yeah, but I mean, that's actually, that's good, right? Good to be conservative, to think about on the safe side. I personally never buy any insurance, and in fact, I buy all the insurance for my cars. But yeah, but that's because I had a lot of car accident before. But apart from that, we almost always underestimate the tail event, underestimate likelihood of tail event, and then when a tail event actually happens, we overestimate the likelihood of tail event. So we can never come down to what the right level of tail event is. And that's where my PhD research is, right? My PhD research was actually looking at the distribution, risk neutral distribution. And it's quite fancy. It is using quite fancy models. But one thing I remember learning is that we can never actually recover the true skewness of the market. let alone the kurtosis, because kurtosis matches the fat tails, how fat a tail is, right? We can never do that. So that leaves week 9. This is probably the week that you can walk away to say, I want to read books about it, because people actually do use that to make money, right? And they use that to bankrupt as well, right? But we almost always hear the more positive stories about it. So and this diagram over here tells you why this is important, right? Because it allows you to express your view in a different dimension. So previously, prior to this unit, doesn't matter what you do, does not matter what you do. We pretty much just dealing with, are you positive with the asset movement, which means do you think the price is going to go up? Or are you negative about it? Or are you neutral about it, right? We pretty much just start with 3 views. I don't think there's any the third view that could happen, right? But pretty much it. And let me show you a slide that I think is interesting. Again, it's not exactly directly relevant to what I'm talking about here now. It's relevant to a unit. This is a different lecture I covered. It's called volatility trading. It's actually building some of the stuff here. But let me give you an example. All right, there we go. This is from your week 2, week 3, I think. I mean, it's about futures contract margin. I may have not talked about it in my tutorial. I forgot. I may or may not, right? But here is an example that I think I just copied from your lecture note from your tutorial. And so here is an example that illustrates how you calculate your margin account. We take that as an opportunity to revise the margin account. So here, you take a long position. We have what you call here initial margin requirement. And the initial is kind of misleading. Initial does not mean at time 0. Initial means that if you have to restore back to the initial level, right? It does not mean time series wise. That's what you did in time 0. Just mean whenever you get a margin call, that's the value, that's the level you have to restore back to, right? Initial value. And here's maintenance account is all at straight to time 0, right? Same value. So what we have here is that this example shows you if the market goes down, say by 4 points, given it's $25 per point, you lost $100, and means you have to top up your margin by 100. And if it goes up, or if it goes up from 30 to 49, it goes up to by 19 points, which is times 25. You get 475, and do that, and then you don't have to do a margin. But what's the insight behind this slide? Because again, I may or may not have talked about it. I forgot. Is this return window that I never get to show you? I don't think I have actually shown you. Think about it. If you think about it, right? What's the investment that you make here? What's the size of the investment you have to make? How much money do you have to put in? Just don't. You know, I mean, you still can see the yellow, but cover it. Just pretend you can't see it. Just think about here. How much money do you have to put it down to play this game?
Marginal call balance.
Yes, exactly. That's how much you start your money, right? You put in $3,250. I'm sure everyone has that, right? I'm sure everyone has that account, has that money. But think about the return you can make. Day 1, you lost 100. So on that day, you lost 3.1% of your money. What do we assume the interest rate per year is? Usually 5%, 6%. It's actually now 0.5%. You get 0.5% per year. This is per day.
Yeah.
It's 3.1% per day, right? And if you lost another 50, that's another 1.5. But think about this day, where you go from 4649 to 4719, you actually get $750, right? And what's the daily return on that day? 47%. All right. Do you not understand now why people playing leverage product? Like, you know, when people say, well, I play Gobi and I play the Heyuan, this is how much, this is how people actually lost their entire fortune overnight, right? It doesn't have to, I mean, it doesn't have to be a huge movement in order for you to get, you know, something like 47% return. And that's why people like this, because the leverage product, right? Leverage product,
And then of course you lost about 24.3%. So accumulatively, after 5 days, after sitting there for about 6 days, you gain about 5% return overall, but your accumulated return could have been 60.8% on 1 day. Sorry, by day 4, right? But that tells you why people buying futures contract, why people buying options, because they are leveraged payoffs, which means you don't actually have to buy, you don't have to pay $24 times that in order to enjoy this benefit. You only have to pay 3,250, right? And yeah, people think about that. It's like, geez, 47%. I think something's gonna go up. I would do that. I go to the futures contract, and then that also explains. There was like, you know, if you go to the S&P 500 futures, they have S&P 500 mini futures. Mini futures is the mini version of that, but still very leveraged, right? But why they create leverage a mini product? Because they want everyone to play this game, right? And why does the exchange want to do that? Then why would anyone invent this product? Right? Keep thinking about this intuitive question. Why would anyone do that? Why would anyone introduce futures contract to do this? Risk management, hedging. Then I mean, think about this. They provide a service to you, right? They provide a service to you. They can charge you transaction fees. And they get your money to put in your margin account, and they pay you a very small interest rate. But they can allocate that money to someone else to get a high interest rate. They walk away with the price difference, right? And that's why you learn finance, right? You learn finance not because oh, this is important. It's because the idea is the sort of like philosophy that you learn behind finance, that keep thinking that the reason why we do this is because we're trying to encourage people to trade, right? We make you to think that it's important to know futures contract, but it's actually not important to know futures contract. But people say, oh, it's important to know that. I want to hedge my risk. But when you see a 47% return, you don't think that's a hedging anymore, right? You don't think that's hedging anymore. So that's actually a very important example. Yeah, I usually talk about it in my lectures, but I didn't talk about it in my tutorials. I guess that was because when I was running tutorial, I keep thinking about questions to ask people, because just such that everyone can walk away with a 1%, right? I just like with that mindset, I didn't talk about it. Anyway, so that coming back to this slide, now you should know why here positive. You know, when you see a positive, why people buying call option positive? Not only because call option give you an unlimited payoff, it's because when we draw a diagram, right? Oh, actually, let's just use an existing slide, so I don't have to navigate it again. Don't. Oops, wrong one. All right, so here's the call option payoff, right? And if you take a quick look at this, when people think about your view on underlying assets positive, why is here positive buy asset? Not buy asset and buy, buy call. Why is that buy call and buy asset together? Why is that they're not saying the same box? It's because of this. If you look at this diagram, right, it gives you a downside protection and upside potential, unlimited potential. But then people say, well, that's the same if you buy a stock. If you buy a stock, you also have an unlimited upside. Why is that the case? It's because call option is leverage product, right? Think about that margin account example. Because call option here is leveraged, you don't have to pay, you only have to pay the premium, and then you can enjoy all this 40% return, right? I mean, I had a 40% return overnight. I was very happy, right? But then I lost it, of course. That's why I'm teaching. So yeah, so understanding the idea behind this matrix, because that's useful in real life. Because if now we're introducing a second dimension, which is what is your view on volatility, right? Let's just say if you think about the market is going to move a lot, comparing to if you don't think market is going to move a lot, you're going to stay in the middle, just like stay as what it is now, right? Quiet. And for example, if I ask you to think about next month, June, what do you think about the volatility level going to be? Well, you say, I don't know, maybe neutral, I don't know.
man, because neutral is being a good answer, or you're negative about it, saying I think the market is gonna be really, really quiet. In fact, I think nothing's gonna happen. It's so boring. There's not gonna be any trading in the market, and no bad news, no good news either, right? And negative, so it means I think the volatility is gonna go down. And this one tells you all the different possibilities for you to do that, right? So if I were the examiner, I would ask you to think about if you have a neutral view on the underlying asset, which means you think the underlying asset is going to be bouncing between like 1% level, within 1% level, and you think the volatility is going to go down, which means you don't think the market is going to move a lot, right? Which one? How would you do it? Well, here it tells you sell straddle, sell strangle, buy a butterfly thread, because they all have this V shape, upside down V shape. Do I have this? Yeah, they all have this upside down. So this is a straddle. Straddle is buying call and longer call, and because you have a straddle, you have a inverse of that, right? Which means I have the opposite of what a straddle is, short straddle, right? That means the opposite. That means I'll get paid positive payoff right in the middle, right? And I have a strangle as well, and so that means I just do all the opposite of what you would do. So this is kind of like personally, I think in practice, this is actually very, very important in practice, knowing how to do that. Yeah, but I think your tutorial question already covered quite a bit. Yeah, I don't have anything else to add to that point, right? Actually, the other thing, if I could. Oh, this is my handwritten note. The other thing is that, so I guess you may get an MCQ, I don't know, is that for 11.21, when you have more than one, so this is so some of these are non-standard combination, right? And spread. So if they're non-standard, that means you have to understand the idea behind it. So for example, if it has more than 1, 2, 3, 4, 5, 6, 7, and 10, right? Or whatever that number is. How would you work out what a graph looks like, right? So in this case, I think that was a good example of showing you. Oh, I actually forgot about the number. One shear and short focal. So one shear is always just go straight up, right? Means if below that you lose, above that you gain, right? So one shear. But for call option, how would you actually illustrate a four of call options? Short call options is going down, right? Going down from your view, going down, right? Flat, going down. So if they don't exercise, I walk away with profit. If they will exercise, I will making loss, could be unlimited. And here, for one call option, one option is short put. The slope here is -1. Sorry, 1 here, slope. For call option is -1 slope. The reason why slope is 1 is because my payoff is ST minus K. Differentiate that with ST just becomes 1, right? So that means it's going to be 45 degrees, 1. If I have 4 of that, in fact, if I short 4 of that, that'll be -4. So which means that's going to be a lot steeper, That's where how you can sort of like, and then -4. When you combine -4 and +1, that becomes -3, and that's how you would draw that in that case, right? And yeah, but in practice, this week is very useful. In exam, I don't know how that can be asked. So I've got a chat box for all the spread content in a unit. For example, bear spread with long short and short put to minimize risk. Are we wasting the transaction cost on both ways? Do people really do that? Yes, people do. Unfortunately, people actually do that. The reason why people do that is because they think they know something. That's why you trade. Because I mean, the reason why we trade is because I think I know something that you don't, right? And people trade on that. And yeah, but unfortunately, people actually do that, right? So not only you transaction cost, but it's just because they think that the more complicated you do, the higher chance that you will have a higher chance to win. But that's not guaranteed, right? If I know something for sure, I just buy a call, right? I just buy a call if I know something for sure. Why do you do all that fancy stuff? But nevertheless, we provide you these tools for you to use that such that I walk away with this service fee, right? So think about finance is like a subject that the sell side people write. Sell side means I sell something. Sell side means I provide financial services, right? So which means that I walk away with all this payments that never existed before. And week 10. So week 10, you just did it recently. Binomial tree. Yeah, in the assignment as well, week 10. And is there anything that is particularly useful with 10? I don't actually know. I mean, it's quite useful because, as you know, some of you know that in my tutorial that this binomial option pricing model is invented after Black-Scholes. So in fact, we should learn Black-Scholes first and then learn binomial tree. But in every textbook, people start with binomial option pricing model. It's because it's a lot more intuitive, a lot easier, and it coming from a good heart, coming from people who 3 researchers, 3 professors. They think that we have to teach people Black-Scholes, and I know that they are not good at math. There's no way for them to walk away to say they know it. And then if they're not happy, I'll lose my job. So how can I make sure that they walk away knowing something and it's not completely useless? So they actually then come down to say, I'm gonna invent a static. This is what we call static model. Static. Notepad. Oops. Was NT-EPA. So I don't know what NT-EPA is, and after I search it, I still don't know what NT-EPA is. Anyway, it was supposed to be Notepad. Static. So it's called static and dynamic. So or continuous, right? So static. So Black-Scholes is the dynamic model, continuous model, where binomial tree is a static model because it's 1 or 2 or 3 is discrete times finance, discrete time finance. So here it's very intuitive, right? It's very intuitive that if you think about it, the movement is going to be going up or going down. But does anyone actually know why we only assume 2 directions, up and down? Why don't we assume a third one? So here we know binomial here is we're going up and down, right? And it's like it's intuitive to say, oh, of course, if you cut down the interval to very small, it's either going to be up and down, right? But why? But why just up and down? Why not stay in the middle? Because the price doesn't have to move. And there were a few reasons for that.
If the price doesn't move, it makes no sense.
Well, the price doesn't have to move, right?
To predict what it looks like in the future.
Yes or no, but yes. Well, if you think about it, well, if you look at an example of binomial tree, right? You could say if you grow that into 2 steps, that becomes three likelihoods, right? 3 outcomes. So which means I can just cut my interval smaller and smaller and smaller. That's one reason. But there's another even more important reasons. I mean, in fact, if I could have the complete freedom on writing exam questions, that would be the question I ask. Why do we assume 2 steps in binomial tree? Because that is a lot more important than knowing this formula, right? Because we want to walk away to knowing why we're doing something. Why do we do 2 steps? one reason is because we can actually extend it to cover 3, 4, 5, 6, 10, right, 1,000 scenarios. But the true reason here is that we only have 3 assets in this class. So let me actually start doing something that is probably not useful for exam, but useful for your understanding of this unit. So, and so I don't think this is going to be example, and I hope it won't, because it's quite difficult, because it's actually beyond this unit. But it's something that we should teach you, right? So in this framework, what you're assuming, let's start with something that we know. So here, right? So in this model 3 result, this is what we know as POCO Powder, right? We all know that. How many assets do we have? How many asset class? How many different assets we have here? How many different assets we have here? We have 4, right? We have a call. We have, what do you call this? What do you call KE minus RT? We can think about it as a bond investment. Bond investment, you can just think about it as just like cash or risk-free asset. Doesn't matter what you think. It's a risk-free asset, K minus RT, invest at a risk rate such that will grow the K. The third one is a put option. And the fourth one is the underlying asset, right? And we know that this 4 is perfectly balanced, which means if I were to replicate a call option, long call, so a long call option is minus C, because I pay C in order to get a call option. That can be replicated. That can be replicated by what? You can rearrange the formula. Right? If you rearrange the formula of the above, you get K minus RT minus P minus S0 equals minus C. So which means a long call is equivalent to this. And the reason why we care about replication in finance is because no arbitrage. That is the fundamental of how we price things in finance. No arbitrage means this. If A and B gives same payoff, then price in A should be equal to price in B. If not, then haha, right? It's something that we can do, right? I don't know how you're gonna do it. You may do something differently, but that's what we say. If A and B gives you the same payoff, price should be the same. If not, then that means if I want to find out how to price A, I just need to figure out how I can create a strategy that gives the same payoff to A. And this is, I can't emphasize how important it is in finance, right? Because with all this financial innovation, right? To Zheng Yuxuan, right? Because you're the only non-financial student in this class. We talked about it over dinner yesterday. With all these financial innovations, right? We don't actually have a guideline to price things. We don't have a guideline to price swaps. We don't have a guideline to price options. But our idea here is that if we can create a payoff such that mimic your payoff, and if I know how to calculate price of B, then I can calculate price of A, right? This is like, for people who don't speak Chinese, this is like 曹冲称象, right? If I don't know how to weigh an element, if I can't cut it into slices, I'll put in the bowl, right? That's exactly the same idea. That's what we do in finance. So which means in this case, if I want to replicate a call option, I do this. And because they give the same payoff, right? You can just do that in your own derivation, right? And if this is actually more than that, that means there's a mispricing, right? And vice versa. But here is what is assumed, and is not an unreasonable assumption, is that what if we only have 3 assets? So which means we can either have a, let's say we just have a call option. We don't have a put option to observe. So now we have just 3 assets: call option, risk-free asset, underlying asset. So here we don't have a put option, or you can just say we have a put option, we don't have a call option. Because if we have both, then we have POCO parity. We don't need to have a model. So let's say if we only, that's all we have there. How do we actually go price call option? Well, we know that we can't replicate a call option because the P here is missing. If P is missing, it's not going to be an equality. Or in fact, that gives you, like a low boundary for call option, right? So which means that how do we actually then do it then? So in this case, then we have to rely on assumption. So now we're introducing assumptions, which means now we're gonna build a model, because model requires assumptions. If there's no assumption, we don't call it model. We don't never call a POCO parity model. We don't have a futures price model because futures price does not need an assumption. Well, it needs some assumptions, but don't need an assumption on how the stock price moves, right? So speaking of which, quickly draw that. This one is a model-free result. We don't need a model for it. We don't care what S0 is, right? You can go back to week 3 to think about how we actually arrive, week 4, how we actually arrive at. But that's a model-free result. We don't need to assume stock price goes up and down or up and down, right? But now we need a model. And the reason why we need a model is because, again, we only have 3 assets. So let me show you. So with this 3 assets, I can do 2 things. First one, I can replicate a call option. Replicate, I put quotation mark by, because if I want to replicate a call option, then I don't have a call option. That means by taking a position in the underlying asset and risk-free asset. Secondly, you can replicate a risk-free asset by taking call option and stock price, right? Underlying asset. So in your lecture note, your lecture note, this is what you did, right? Because you create a risk-free strategy to replicate a risk-free asset by taking a position in call option and a stock price. Alternatively, you can replicate a call option using that method. Let me start with 2 and then go to 1. Personally, I like that one because that is consistent. But second one is what's used in Black-Scholes. So if you understand that, but you should know they are both equivalent because they both require assuming what we know about stock price. Okay, and let's start with second one. Replicate a risk-free asset. So let me just in case if I make mistakes, let me just go to my tutorial. Let me quickly check my handwriting. Yeah. So here, what you've done in your lecture note here is that we take a short position in call option minus C call minus 1, in fact, which is minus 1 call, and delta shifts, right? So initially, I have this. So F0 just means the value of my portfolio is worth -1 times C plus delta times F0. right? So don't worry too much about, it doesn't have to be -1. I personally prefer just whatever number you put in, it will give you the same answer anyway. But that's what your lecture statistics. So, and then saying here, the stock price is gonna go up to SU, gonna go down to SD, right? We assume that. And that means if you go up to SU, we know CU, because CU equals to maximum of SU minus K, or 0, right? Such that we know what CD is. Yes? Yes? So that in this case, if we go up to FU, what is my value of my portfolio? -1 times CU plus delta times SU, right? If it goes down to FD, -1 times CD plus delta times SD. And what your lecture risk-free strategy. So here, remember, we are trying to do a risk-free strategy. What does a risk-free asset means? Exactly. So which means doesn't matter what the market condition is, a risk-free asset means there's no uncertainty, which means there isn't going to be any surprises, such that if it's risk-free, FU equals to FD, right? Such that -1 times CU equals to that, right? In real life, now in real life, do I know what CU is? In real life, tomorrow.
No.
Do I know what SU is? Do I know what CD is?
No.
Do I know what SD is? Do I know what delta is? No, we don't. We're just saying here with delta shares. I don't know what delta shares, right? I don't know, right? In this case, we have 1, 2, 3, 4, 5 unknowns, 1 equation. Can you solve it?
No.
We can't solve it, right? So the reason why we can't solve it is because, let me just write it. 5 unknowns, 1 equation. So mathematically, how would you do it? Is that, well, 1 equation I can only solve one unknowns. I just assume I know 4 of them. You think that's bizarre, but that's what people do. That's what's actually behind this binomial model. It's simply complicated by coming from this very naive thinking. If I want to solve this equation, I have to assume I know 4 of them, 4 of the 5, right? And it's unreasonable to assume I know delta, right? So which means in this case, I assume, here's my assumption. I assume that I know SU, right? Such that it will give me CU, right? And I know SD, which will give me CD. So which means 1 unknown and 1 equation. That's what it comes down to, right? And then you can solve for delta. And solving for delta, what do you have? You have CU minus CD divided by SU minus SD, right? That's what you learn in the slide. That's how you come down to delta, right? And now you can bring delta. And now you can bring delta back to here. Why you can bring delta back to here? Because now F0 equals to FUE minus RT, right? Because it's a risk-free asset. F0 equals to FUE minus RT. And delta is calculated. Spot price is observed. What are we trying to find out? Is C, right? That's it. You can solve for C. And that's how we do it. And this is the first way to say how we price something is to replicate a risk-free asset. And now take a look. Can you understand why we have 2 directions? Well, that's because that's the only possible way for us to solve this. There isn't any other fancy explanation to say, oh, 2 is easier. No, that's the only way, right? We can only solve this by using just 2, because we can equate these 2 equations such that you arrive at this, right?
Yeah.
If you have 3 equations, that's going to be even more unknown variables, right? And that means we only have 1 equation. So that's the first one. That's what you did in lecture notes, something that you should definitely understand. The second one is my personal preference. And let me just actually sharing my screen using what I handwrite on the in other places. Is that one? Oh, there we go. My handwriting. All right. Can you see the handwriting? Yeah. So again, am I sharing that? Oh, there we go. I'm sharing it. So because this is actually not what's in your lecture note, I will quickly talk about it, even though that's my personal preference. So what's going on over here is that, again, we assume share price go up and down, right? And if you have saving account, go up and down doesn't matter, right? Doesn't matter. And call option go up and down, CU and CD, which is determined by what SU and SD is. And that's what we're trying to find out. Here, as an alternative approach, is that we can buy, so we're trying to use those 2 to replicate call option. Previously, we're using a share and a call option to replicate a savings account. But now we're using that and that to replicate that and that to replicate that. You can think that you probably can use that and that to replicate that as well, right? Because it's straight, doesn't matter how you combine. So here, what we do here is that I can buy Delta shares and I invest $B, right? I invest $B. I don't know what number it is. And because if you go up to CU, that equals to Delta times shares plus my savings account, B times my savings account. If it goes down, CD, which is my call option, equals to Delta times my shares plus my $B I invested times the interest rate. And in this case, I'm not equating CU equals to CD because they don't equal to each other. But what I do have here is that I know what CU and CD is. I know what delta, I know what the spot price is, and I know what the interest rate is. So here I have 2 equations, and what are 2 unknowns that I have? I don't know what delta. I don't know what B. But I can solve it because 2 equations, 2 unknowns. I can solve it, solve for delta, solve for B, such that if they give me this, then I can work out what C0 is, right? At time 0. Delta times shares plus B. It's just really the same idea, except this one, you're just trying to say, I want to replicate a call option. The other one, you're trying to say, I'm trying to replicate a savings account. And do you know why binomial and your lecture note, as well as Black-Scholes is trying to say, we want to replicate a savings account? Intuitively speaking, let me swap back to my iPad again. Because this one you can just glimpse it because it's not even covering a lecture note, even though I like it because I find it more intuitive to me. Think about why do we try to replicate a risk-free asset?
The same expected payoff.
Semi expected payoff, yes or no? I mean, I will say yes, but here, think about a new term that you learned in this week, risk neutral, right? So I mean, in the lecture, you go through the risk neutral distribution, risk neutral probability, risk neutral framework just means if you think about the binomial, like you calculate the price, the probability of going up equals to ERT right? That's the P, right? This P here is what is known as risk neutral probability of going up in the Q probability space. So here it just means that in this case, if that was the probability going up, that means everything will grow by risk neutral rate on average. That's what I'm saying. Such that expected price of the asset equals to S0 ERT. And in the risk neutral framework. So that simple idea behind that, think about in this risk neutral framework, everything grow by the risk rate. That is actually what won them Nobel Prize. Think about how big Nobel Prize is. But that's how they actually won it, right? But that's how what couldn't get recognized by economists at the start. People saying that's stupid, right? That's like, why did you even make that assumption? But it's important to know how stupid that assumption is, knowing the shortcoming of that. So here we're assuming in that framework everything go up by risk rate, and such that it makes sense for you to create a riskless portfolio, to replicate a riskless portfolio, right? That's what you do. So this one, coming back to that point again, if the question gives you real probability, saying, I know that the probability of stock gonna go up by 20% tomorrow and go down by 80%. Do I use that probability? The answer is no, I don't use that probability. Well, it's because in pricing binomial, we're trying to replicate a riskless asset. We stick with this risk neutral probability, right? You stick with that. So that's just like a misleading information gives you, right? And of course, no one knows the probability for sure, right? But that just tells you the actual probability, the actual outcome does not matter, right? Does not matter. All right. So, oops, I'm trying to scroll my share window. And I guess that's it for that for binomial tree. And of course, you should know how to grow them, and and if there's a dividend paid, how you should deal with dividend, right? And if it's American option, how you should do American option. Nadine, yeah, can I ask you a question? Because you were smiling. I don't know why you're smiling. So for American options, how would you work out whether you should early exercise? Yeah. What payoff? So I guess the first thing is that you calculate the early exercise payoff, and then you compare with what the European will give you, right? So that means let's say you always start with the end, right? Coming back to this point, and then think about if you don't early exercise it, you hold it like a European. What does European give you? And if you start off, if that is higher, then take the American and forget about that and just use that number and replace that, right? That's just, again, that is tedious, but that's what you do, right? It's tedious. And there's no other tricks with binomial tree. It's just hard. It's just very long, and we don't use that. And I suppose the next one is the last one. I mean, you guys learn about Greeks. Which one is it? I know that one. So we talked about Black-Scholes Merton model 2 days ago in our tutorial class. Feel like that was yesterday, but it was the day before yesterday, so it's not that far away. So knowing the formulas is important, obviously, and knowing that you can't use that to price American, and knowing how to look up numbers N and D, and given that it's open book, that means I don't think the table will be supplied. It means that you have to look up your own tables. So in your tutorial questions, you will go through how to actually look up these numbers. Yeah, so make sure that, for example, that's the tutorial example I had.
is that if your D is 0.5365, how do you work out the cumulative probability for that, right? Because N here just means the probability. Means what's the probability if for a standard normal distribution, you get an outcome that's less than 0.5365. That's just what I mean, right? So what you have here is that 0.5365 goes to 0.5, 3, and 4, somewhere in between, right? Don't use your ruler to measure how far away that is. You use that formula, which is 5.3 plus 65% of the gap between 5.4 and 5.3. And do the opposite if it's negative. When I say the opposite, it's really the opposite because this is the lower number of the two. That one is the larger number of the two because minus 0.12 is bigger than minus 0.13, right? Larger number of the two minus the percentage of the gap, where positive is small number plus percentage of the gap, right? So just knowing that, make sure that you get the right answer.
Okay, so Greeks. Greeks. Do you guys learn Greeks? I didn't even check. No? What did you learn in week 12? What did you learn? Sorry, it's 2 days ago. Sorry, so you did learn Greeks, right? You did. The whole thing? Whole Greeks? Let me confirm. It's always good to confirm. Learning materials. And you can think about it and say, if I'm not getting 100% of this unit, I will just forget about risking options. Let me see. I don't actually, because that may be a different week to what I would teach. All right, it does teach Greeks. Okay. All right, pretty straightforward. Did Andrew go through the whole Greeks? Yeah. All right. Is great in exam syllabus? I don't know. I think yes. I mean, I think yes, right? Because it's part of your unit. And so Greeks here is that so Greeks refers to how you quantify the price of the options with respect to many factors. So here, everything is based on Black-Scholes. So because you actually need to have an explicit format, explicit form. So the right-hand side is what it is. Sorry, the left-hand side is what it is. But the right-hand side is what you get if it's assuming Black-Scholes. Which means if you're assuming another model, like Hester model, another model, right? Another model. If you're assuming another model, you get different grades. That's for sure, because that's coming from. If you can calculate that from binomial tree, you get different grades again. But these grades in this framework is based on this. So what the grade here is that we have 5 grades, 6 factors affecting the core premium. Remember we learned that in week 8, 6 factors. Here we remove one of the factors. We remove 2 of the factors. And we bring in additional one. So delta is the call option price with respect to stock price. All that one is saying here is that because stock price moves, and the reason why we don't have a DC decay is because strike price doesn't move, right? That's why we remove it. But that's the fixed term that doesn't move is what we agreed on. So delta means that if the stock price tomorrow goes up by 1%. Why do I care about 1%? Why do I care about 1% of the return? Because of this, right? Because the leverage product, right? Even though it looks like a 1%, it may turn out to be 47% on your portfolio, which is why we care about delta, right? So hopefully that table also give you the understanding again, intuitive understanding again, why we care about it. So in this case, if stock price goes up by 1%, what is the change to call option premium, right? You can, because the ND1 is like overnight return of your portfolio if you're holding one option. And same thing for put option. Gamma means if it's a 1% change, what is the 1% change in my delta? Right, that's what I say. So this one is like, if you are driving the car, are you going forward or are you going backward? Delta tells you I'm going forward. I'm going forward. But gamma tells you how fast are you going, your acceleration, right? So which means that it also is important for you to know that. And theta means as we're approaching the time to maturity, right? What will be the impact to my call option premium? Is a long number that no one cares, right? We derive it, but I don't even know what that is. I never look at it. In fact, I've never actually written down my life, but we know that it exists. Theta. Vega means if there's a 1% change in volatility, what's the 1% change? What's the percentage change to my call option premium? That's also important because remember we have two-dimensional views: stock price movement, underlying volatility, right? Raw here is again is negligible because nobody cares about interest rate these days, right? Probably in the old days when inflation rate is really high, that's applicable. But here it's just knowing that. Yeah. So and that also tells you why interest rate is a positive effect to call option, negative effect to put option, because this is actually a positive number, right? So it tells you why. So knowing how to calculate them, I guess that's one. And the other thing here is that important for that week is the delta hedging. So delta hedging here is simply means this. What's the easiest way to say it? Is that because I worry about my movement. Remember, some people say I buy call option to hedge, right? To hedge. But here I'm saying I have a call option. I want to make sure that my call option itself is hedged. I want to hash that again, right? So which means that I know if I have a call option, my delta is ND1, right? From the, just trust me, that's ND1, right? Yeah. ND1. And how can I make that to be delta neutral? Which means, how can I create a portfolio such that if I'm holding a call option, ND1, how can I add something such that my overall position is delta zero delta, right? That's just what the remaining is about. So what that is about here is just, again, think intuitively. Call delta is ND1. One stock. What's the delta of one stock? Just one. That's right. So utilizing a call option and a stock would be able to so here, if I have a call option, the delta is ND1. I have to do something else such that the delta is minus ND1 such that my delta is 0, right? That's what that is about. If I have long one call option, my delta is ND1. What should I do here? This is the question mark. Such that my overall delta is 0. And how do I find that? One thing here you can go, well, how about you short one call option? Because if you short one call option, it's minus ND1. But then that's stupid, right? Because if you long one call and short one call, you close it. You basically close all your position. So you don't do that. And what else can you do? Well, alternatively, you can think about, you can long put as well if you want to do, right? But yeah, but what we, because that will change your sort of your gamma again. So what's going on over here is that recognizing what is the delta over here. What's DS? 1. So which means one share have a delta of 1. How many shares do I have such that how many shears such that my delta is going to be ND1 minus ND1. Minus ND1 shears, right?
Yeah.
Because of that, right? So that what we're doing over here is short ND1 shears to create a delta neutral position. And that's it. That's what delta neutral means. Delta is hedging, right? And if you understand that, you can just keep reading the lecture slide. That is the principle, right? I'm trying to create a delta neutral portfolio. Means I have an exposure to delta because of call option ND1. And reason why ND1 is ND1 here, the number may change because depending on what S0 is, right? So that number changes. So which means I want to short ND1 shears at time 0 such that I will create a delta neutral position. And let me just ask, if you have to maintain a delta neutral portfolio, how often do you have to rebalance it? How often do you have to rebalance your portfolio if you have to maintain a delta neutral strategy?
Depends on the trends of the stock, because the stock price trend, the delta of the trend, so we need the balancing.
Yes, that's right. And in fact, the answer is like as often as you have to, because ND1 depends. What does D1 depends? S0, K, R, T. So if S change, T changes, you have to change that. So which means that this is what people call a dynamic rebalancing. So which means that you can't actually create a perfect delta neutral portfolio. And what does that remind you? That reminds you a duration-based hedging for bonds. If you go back to well, this is again, this shows you everything's linked, right? If you go back to I don't actually know which week that is. Let me go to the week. I know it's something like week 5. Week 4. Thank you. Week 4. No, week 5. Sorry, interest rate. Good guess. It deviated by 25%. If you're going back to week 5, yeah. So in week 5, you have something called duration hedging. That just means I want to create a portfolio such that you match by the duration. I mean, the idea is all the same. Just like a delta hedging, just like duration hedging, they all mean the same thing. Means I want to net something to be 0. And then here, the benchmark is now duration, not delta anymore. Delta hedging means I want a delta to be neutral. This one, I want it to be duration to be neutral. So unfortunately, it's already 14 to 12. So we passed 14 minutes. But yeah, so make sure you utilize discussion forums, and I will try my best to help you guys on that, right? And also have another consultation online, so you guys can feel free dying and to, I don't actually know which, no, I do know, 10th of June, right? 10th of June. Sounds like very far away, but 10th of June, that's when we, 10th of June, that's like 2.5 weeks away. When's your exam? 11th. Jeez. Hopefully not going to be too many people on the day, but you can utilize discussion forum. So if you want to get help on any time, use that, right? Use that, and that's it. Thanks, guys. Thanks for coming, and thanks for coming on Zoom as well. Thank you. Lovely. No worries. Bye. There's a dog.